access that session, you just need to go to the resources area. There will be a link to the session. Basically, you will find a link to the session within the resources area. If you go further down, you see Cloud Classrooms. Cloud Classrooms is where you need to go to access the session. Basically, there will be a link to Blackboard Collaborate Ultra. Okay, so it is where we will run the session. So for now, just keep in mind the timing of the session. That is important. And if you have any issues, questions in particular regarding the first 4 lectures, please feel free to ask. Okay? Good. So this is the main thing for today, right? But like I said from last time, we had a problem set with some questions. Some of them are coming from the text, and the solutions have been provided. You can go to the resources area, and it is where you can download the answers to those problem sets, right? So just go to topic 2 folder. You will find the problem set solutions for topic 2 part 1. Okay, let me just go through that problem set before we begin with the main discussion for today, which is the balance of payments. Okay, so this is a problem set, right? Let me bring that up again. Sorry about that. So the problem set contains some questions from chapter 5 in the text, right? And the solutions for questions coming out of the text, they are prepared by the author of the textbook. Please take a look when you have the time, and let me know if you have any issues in understanding the explanation, okay? I guess everything is transparent, straightforward. Now, I just want to focus on the so-called XR problems, okay? So why XR problems? So we believe that by giving you XR problems, you have another opportunity to practice what you learn, am I right? That is number 1. Number 2, eventually we will have the final exam. And the way that we design the exam questions will be based on the XR problems. Okay, the XR problems. So eventually you will see some versions of these XR problems in the final exam. Okay, so no surprise. In the exam, that is my promise, you will see similar kind of questions during the trimester. Okay, and they come from the problem sets, right? At least that is part A of the final exam. Okay, part A of the final exam. So by the way, around week 6, I will upload some past exam papers. You will see the point. But for now, just keep in mind that the XR problems, they are extremely important because the exam questions will be based on them. Okay. Now, of course, I'm not going to give you the exact question. That is impossible, correct? I might give you very, very similar kind of wording, similar kind of setting, different currencies, of course, different numbers, for sure. Am I? So, for now, just keep in mind that plan so that you know what you expect in the final exam. So there are 2 XR problems in topic 2 part 1. The first one is this one, right? XR problem number 1. So you are given 2 exchange rates. The first one being NZ dollar slash US dollar. Okay? NZ dollar slash US dollar. So the exchange rate between the US dollar and the New Zealand dollar, the Kiwi, right? There are 2 numbers. We all know that the first number is called the bit rate, right? The smaller number is the bit rate, and the second number is the larger one. It is the offer rate or the ask rate. Okay. Another exchange rate that has been given is USD slash Singapore dollar. Okay, Singapore dollar. So the second exchange rate is basically telling us, so the first exchange rate is telling us the value of $1 US. Okay, again, like I said last time, that is a convention in this unit. We use that method of expression of exchange rate, right? A slash B means the value B. So NZ dollar slash US dollar means the value of $1 US. Okay, $1 US is equivalent to this amount, right? Depending on you buy or sell, what you do with the bank, right? If you go to the bank to buy, they will quote the offer number, and if you bring the US dollars to the bank, they will quote the smaller number, the bid number. Okay, and likewise, you have the value of $1 Singapore dollar in the second exchange rate, second quotation, and they are based on these numbers, right? The bid rate and the offer rate. Second exchange rate, it is telling us the value of $1 Singapore dollar. Okay, and of course in US dollars. You have only two currencies at the end of the day, right? For every exchange rate, you have two currencies. Then clearly when we say that it is the price of one currency, it must be in terms of the other currency, correct? There's no other setting there. Okay, our job is to find the cross exchange rate between the New Zealand dollar and the Singapore dollar. And we need to explain the steps under which we arrived at our answers. Okay, is the question clear? Similar to what we did last time, correct? So last time we had also two exchange rates with the bid and offer values, and then we bring in the cross exchange rate equation, correct? And we explain why we ended up with those numbers. So our job here is to do the exacting, right? The exacting. Now the question asks us to find this exchange rate, right, between two currencies, New Zealand dollar and Singapore dollar. So it is totally up to you, right? If you are comfortable with Singapore dollar slash NZ dollar, just go for it. That's fine. If you prefer to find NZ dollar slash Singapore dollar, that's fine too. It doesn't matter, okay? I know at the end of the day, it depends on which exchange rate you pick up. The answers will look slightly different, of course, right? Because it's A and 1 over A, but we understand that. So just be comfortable with what you do, and you should be okay. Okay, like I said, the solutions have been provided, so let me just bring the solutions up, and do let me know if you have any issues. Again, we have two exchange rates, and the way we provide the answers to this question is that we bring in the equations, right? And we don't have to prove it. It is coming out of the lecture, the cross exchange rate equation, okay? Everything is transparent. So the very first thing I do, as you can see, is to provide, first of all, I make it very clear. I find the bid rate and then the offer rate, right? I separate my answer into two pieces, the bid rate and the offer rate. And at the end, I just need to wrap them up in a very nice structure, something like this, and I will get the answer, right? So I have so this one is the offer rate, and this one is the bid rate. This one, right? Or the other way to say is this one. Okay, so anyway, so they come from the equations, our equations, right? So why those equations? So last time we talked about the equation, right? X slash Y equals X slash Z divided by Y slash Z, correct? So I need to fit that formula which we discussed last time. So the formula that I mentioned is given by this one, right? Just before this one. Okay. So this is the cross exchange rate equation from last time, incorporating the bid and offer values, right? X slash Y over Z slash Y. Sorry, I should follow this, order. X slash Z is X slash Y divided by Z slash Y. Okay, and bid is bid over ask is ask over bid. That's all. Am I? So all I need to do before applying this equation is to make sure that I have the correct structure. Okay, I need the exact exchange rates like this: X slash Y and Z slash Y. So in the answer, right, as you can see, the very first thing I do is to derive this exchange rate, which is straightforward, right? It is coming from the original exchange rate, USD slash Singapore dollar, right? USD slash Singapore dollar. I can first of all convert that exchange rate into this one, so that I can apply the formula. Okay, I want everything to be consistent. Am I? I want something to slash USD, because look, the first exchange rate is NZ dollar slash USD. I need another exchange rate that is also giving me something slash USD. That's why I need to convert my original exchange rate, this one, right, into Singapore dollar slash USD before I apply my equation. Otherwise, it's going to be very messy, correct? And that conversion is very straightforward. Just, 1 over the bit number, if I want to find the ask rate, and 1 over the ask rate if I want to find the bit rate. Okay, so the first step is to get this exchange rate right, and then I simply bring in the equation, plug the numbers in, and give the answer. So my answer for the bit rate is simply given by this calculation, where I say that the bit rate Singapore dollar slash NZ dollar. Again, like I said, if you are not comfortable with Singapore dollar slash NZ dollar, you can go for NZ dollar slash Singapore dollar. Doesn't matter. Okay, doesn't matter. The final answers will look different, but we understand, and you get full score for that as well. All right. So this exchange rate is given by Singapore dollar slash US dollar divided by NZ dollar slash US dollar as well. And when I put the numbers in, I have to follow the rule, right? Bid is bid over ask. So bid is bid over ask. So I add the bid number, right, for the first exchange rate, which is given by the equation. Sorry, by our calculation here. Right? It is a bid rate, and the second number is the ask rate on this exchange rate, NZ dollar slash US dollar. It is given to me by the question, right? 1.3575. Okay, and that's it. That is the answer to my bid question. So I've done with the bid number. So I have found the bid rate for this one. Okay, Singapore dollar slash NZ dollar. And in number, it is simply that one. So all I need to do now is to explain why I have that number, and the way I explained, I justified in this answer set is similar to what we discussed last time, because I find the bit rate on the NZ dollar, right? The bit rate on the NZ dollar. So what it means is that I'm going to sell one NZ dollar to the bank, am I right? In order to obtain the other currency, which is Singapore dollar. So if I bring $1 to the bank, I need to follow two-step story, correct? The first step is that I sell my NZ dollar in order to buy US dollar at that price. Okay? And this is the amount of US dollar I would get. And the second step, I simply sell whatever US dollars I ended up with in step one in order to get Singapore dollar, the amount of the relevant amount of Singapore dollar, right? According to my answer. So the amount of Singapore dollar is given by the exact calculation, right? You see the same number. Okay? So that is the way we go with this kind of question. Any issue? So this is what we discussed last time, correct? So you see another explanation similar to what we discussed during the lecture last time. Now, to find the offer rate or the ask rate, I have also the equation, which is now very transparent. I know what is happening. I know the cross exchange rate equation. I know that the offer rate or the ask rate is given by ask over bid, right? I just bring in the two numbers, which are basically the remaining numbers. At the end of the day, right, I have only four numbers. Two numbers for the first exchange rate and two for the second exchange rate. I've used two of them. I have two left. So this is now my opportunity to use the remainder of the information. So the offer rate or the ask rate is given by this calculation. All right? It is ask over bid. Okay? Ask over bid. And I have to explain, right, why I ended up with that answer. And here, if you look carefully, you will see the logic similar to what we discussed last time. So the exchange rate, the nature of the exchange rate is the offer rate on the NZ dollar, right? It is similar to the bid rate on the Singapore dollar. Because I know that explaining the bid rate would be very easy, right? I just follow this, logic, and I can explain the bid rate on the Singapore dollar, all right? So in order for me to do that, I start with one Singapore dollar, right? I'm selling my Singapore dollar to the bank in order to get NZ dollar. So following these two steps, we know what happens now. Step one, I need to sell my Singapore dollar to the bank to get US dollars. And then the second step would be when I convert my US dollars into New Zealand dollars, all right? And that is the amount of New Zealand dollars I would get following that two-step story. Okay? And all I need to do at the end is to invert that number, right? Because now I need to find the bid rate on the offer rate on the NZ dollar, which is 1 over the bid rate on the Singapore dollar, correct? 1 over. So remember, A, exchange rate X/Y is A, then exchange rate Y/X is 1 over A, am I? 1 over A. So I have all I need to do is to invert this number and I obtain my answer, right? So the offer rate on the NZ dollar is simply 1 over this one, okay? And that's all for my explanation. Any questions? Too difficult? Too easy? Are you comfortable with this being exam question? I'm not saying that's the exact thing, but a similar kind of setting to go to the final exam? No? Yes? Good? At least you know what to do, right? You know the equation for sure. After we've done so many trials and practice, right? You know xz is xy over zy, right? And then at least you can bring the bid and offer numbers. You get half of the marks. And explanation, I think, is straightforward, right? Put yourself in that trader's position and you know exactly what you need to do, right? You have 2 steps and there's no other way around. You have to follow those steps, right? You need to make use of the intermediate currency. That is the only way to go. Okay, good. So let's move on. Another HR problem from last time. Is, I don't know why this one only allows me one. Oh, here you go. Problem. This one. So the second exchange problem, sorry, we have two more. So the second exchange problem from last time is this one. So problem set number 2, exchange problem number 2. The exchange rate between the Aussie dollar and the euro quoted this way, euro slash AUD. Meaning, we are talking about the value of the AUD, right? The value of the AUD increased a little bit from 0.6863 to 0.6873. All right? So the value of the AUD strengthened over that period from the 18th to the 20th of February. Okay? And the question, what is the exchange rate between the above two currencies based on the direct quote from an Australian perspective at the beginning of the period? Similar question, what is the exchange rate? Number 2, sorry, second part of the question, part B. What is the exchange rate between the two currencies based on the indirect quote from an Australian perspective, also on the first day? And then you have to do some calculation about the amount and percentage, sorry, just the percentage appreciation or depreciation of the two currencies, okay? From the first day to the second, sorry, from the beginning to the end of the period, only 2 trading days. Is that clear? So everything is given, right? And I think straightforward, given our discussion last time, right? We know what the direct quote means. The direct quote gives us what? The value of the foreign currency, okay? The direct quote from an Australian perspective gives us the value or the price of the foreign currency in Australian dollars, right? So here, the answer to part A is that we will need to find what? The value of 1 euro, right? At the beginning of the period. Now, the information given to us is what? The value of 1 Australian dollar, correct? So, this number, 0.6863 on the first day of the trading period, that number means the value of 1 Australian dollar in terms of the euro. Correct? So what can we do in order to find the value of 1 euro in terms of Australian dollars? We need to invert the numbers, that's all, correct? So in the answer, we explained that very clearly, right? So in the answer, using the formula that we discussed during the lecture, we know that the value of 1 euro is simply 1 over the value of 1 Australian dollar. Okay, precisely, the exchange rate AUD slash euro equals 1 over the exchange rate euro slash AUD. And it's given by this answer, right? 1.45 something. Okay, 1.45 something. That is the answer to part A. Because the question asks you to show a number, all right? You just put the equation down and provide the answer. That's it, okay? Nothing else. You get a full score. Second question, what is the exchange rate? What is the exchange rate between the two currencies based on the indirect quote from an Australian perspective? Which is the opposite, right? Indirect quote would give what? The indirect quote gives us the value of the domestic currency, right? Of the Australian dollar in terms of the euro, and it's given by the question, by the way. So this number itself, right? So this number is simply the value of 1 Australian dollar. It is the indirect quotation in this case, because we have only two currencies, right? 1 Australian dollar and the other is euro, nothing else. So that is the only thing that we can do. So we just copy the information from the question to give the answer we say that the exchange rate is given by the number itself. Okay, you get a full score. Simply just repeat the number from the question. Okay, and the next two parts of the question ask you to show, to calculate the percentage change in the values of these two currencies. Okay, meaning the percentage depreciation or appreciation of the Aussie dollar and the euro. So the first one, the Aussie dollar, percentage change. What is the percentage change? So it is given by the percentage change equation, right? Remember from the first lecture, we have the percentage change equation, right? It is a new value divided by the original value. Whatever you have, minus 1. Minus 1. Okay? So I apply that equation. If you don't like it, you can find the difference, right? The difference between the two values before and after, and then you divide it by the original value. Okay? By the original value. So the same way, same answer, right? But this is going to be quicker. So I have the new value divided by the original value. And remember, I'm talking about the value of 1 AUD. So I have to find the exchange rate, the quotation that gives me the value of 1 AUD. Okay? And it is from the question itself. Right? So straightforward. I have two numbers given to me before and after. And then whatever I have in this formula, I just take away 1 from it. That is what I need to calculate. And the answer is 0.0015. The exchange rate has gone a little bit up, right? It has gone a little bit up. That's why I have a positive number as my answer, and I can convert it into percentage that way. Okay, 0.0015. To convert a number into percentage term, you need to multiply the number with 100. Okay? Straightforward? Good. And for the euro, you do the same thing. As long as you know the value of the euro before and after, right? You can bring in the equation and give the answer. Now the value of the euro before is given by the part A of the question, right? By the answer to part A. It is the value of the euro before. We need to calculate the same thing after, right? The value of the euro after, meaning at the end of the trading period. So on the last day of the trading period, the value of 1 Australian dollar is given by this number. So 1 over that number will give us the value of 1 euro. Am I? 1 euro. So before we do anything, we need to calculate that. That is the value after, right? After. So the value of the euro before is again the answer to part A, and the value of the euro after is given by our new calculation, right? Which is straightforward, I guess. Okay? And then the last thing to do is to repeat what we did before. For the AUD now we have the rate of change in value for the euro, right? We have before and after values. So we put them in our equation, which is the after value divided by the before value, whatever we have, minus 1. And the answer should be negative because before, right, the rate of change for the AUD is positive, meaning the rate of change for the other currency, that must be negative, right? Because we have only two currencies. One is going up, the other must be going down, correct? So if you put the numbers in, you can provide the answer, right? It is minus 0.14%. Okay? And that is what we expect to see in the answer sheet. Okay? And remember the question asks us about the percentage appreciation or depreciation. So it's better to make it clear. Okay, whenever we see the answer to be positive, we make a conclusion that would imply an appreciation of the currency. Okay, in this case, the Aussie dollar, an appreciation of the Aussie dollar, and likewise, we have a negative value for the rate of change in the value of the euro. So we make a similar conclusion, which is this one, right? The negative value indicates a depreciation of the euro. Okay? Any questions? This is okay for the exam as well, right? I believe. Everything is transparent, a little bit of calculation. But at the end of the day, what else do you expect? Am I right? You have two numbers going from before to after. So in order to figure out the amount of change or the rate of change, I guess it is fairly straightforward. Okay, fairly straightforward. All right, and lastly, the third problem set. Sorry, the third problem from last time. All right, so let me focus on the question itself. This is what we have. The spot exchange rate between the US dollar and the Australian dollar quoted like this, AUD/USD. Okay, so this is important, correct? Because the order of the currencies becomes very, very important. If you put them in a different order, that would mean something else, right? So be careful with the order of the currencies, because this order would imply the numbers we are going to see indicate the value of the US dollar, am I right? Of the US dollar. So we are talking about the value of $1 US here. And the numbers are given by these ones. And it is the spot exchange rate, okay? So we know the spot exchange rate. And now we also know the swap forward values of this exchange rate based on the 1 month forward, 3 months forward, and 6 months forward, right? You see all those numbers. So basically we are talking about the forward exchange rate in this setting. The forward exchange rate is quoted following the swap rate method. Okay. Remember last time we talked about the quotation for forward exchange rate. We have the outright method, similar to the spot exchange rate, and also the swap rate method. Right? You should be familiar with the latter, meaning the swap rate method, because in the assignment, eventually you will need to do some forward transactions. Okay, it is one of the requirements. You need to do some forward transactions, and if you go to the forward market, you see similar kind of quotations. They don't give you outright. Well, they have the conversion, but the numbers you see in the forward area would be the swap values. Okay, we call them the forward points. Anyway, so let's apply the rules we discussed last time here. Whenever, so I think it's better to look at the question. So the first part of the question, we need to calculate the outright forward rate for these maturities. Right? So last time we agreed that whenever the first number is smaller than the second number, right? The first number is smaller than the second number. All we need to do is to add those numbers, those points, right, to the spot exchange rate when we work out the forward exchange rate. Okay. So for the 1 month maturity, the first number is smaller, correct? 15 is smaller than 25. So all we need to do to find the outright forward exchange rate is to add those numbers to the spot exchange rate. Okay? So in the answer we made that clear. So for the 1 month maturity, the forward exchange rate is given by these numbers. Okay? And why those numbers? Because we have added the respective forward points to the spot exchange rate, right? So let's make sure that it's correct. So when you add 15 points to the bid rate, you have 65, correct? And if you add 25 points to the offer rate, you end up with 95. Am I? And that's why we have the correct answer. Oh, sorry. It's not correct. So if you add 25 to 80, you have 105. Sorry about that. So the answer is correct, right? So 1 month forward exchange rate, they are given by that. And 3 months forward exchange rate, in a similar way, we can generate those numbers, right? For the 3 months maturity, we have a similar story because the first number is lower, is smaller than the second number, right? A is smaller than B. So all we need to do is to add those points to the spot exchange rate. Okay? Now the only difference here is the 6 months maturity, right? The first number is now 20, the second number is 10. 20 is larger than 10, meaning we cannot add these points to the spot exchange rate. We have to subtract these points from the from the spot exchange rate. Okay? So for the 6 months maturity, all you need to do is to take away 20 points from the spot bid rate and 10 points from the spot offer rate. That's all. Okay? And the reason being, the first number exceeds the second number. That's all. Okay? So in the answer, we have done the exact thing and we produce that result. The 6 months forward exchange rate, it is given by that, right? Okay, part B of the question. Question? Is that okay? All good? Second part of the question. State whether the US dollar sells at a premium or a discount for each of the 3 maturities. Okay, selling at a premium or selling at a discount, right? We know that as long as the forward exchange rate is larger than the spot exchange rate, right? That respective currency sells at a forward premium, right? Remember the premium discount equation last time? And part C, we have a similar question for the Aussie dollar. And part D, we need to calculate that value, okay? We have to calculate the forward premium or discount for the 2 currencies. Okay? So basically, we see this equation in action, right? The forward premium or discount equation that we need to apply here. Little f equals forward exchange rate minus spot exchange rate divided by the spot exchange rate. And then you convert them into 1 year, right? Using that conversion, 360 divided by the number of days and multiply with 100 at the end, so that you can present your answer in the form of a percentage term. Okay, that is what we want. So in our answer, we just follow that formula basically. For part B, we simply say that because the forward exchange rate, right? We compare the forward exchange rate and the spot exchange rate, am I right? And basically, if you look at this, quotations, you already know what's happening, am I right? Because the values, the spot exchange rate tells us the value of the US dollar, am I right? And the forward exchange rate in a consistent way. So we are talking about the market for the US dollar, the value of the US dollar. So the forward exchange rate is higher than the spot exchange rate for 1 month and 3 month maturities, correct? Because of the quotation. So we know that the forward exchange rate is higher, meaning the US dollar, right, sells at a premium, correct? So we say that the US dollar sells at a forward premium for the 1 month and 3 month maturities, and at a discount for the 6 month maturity, because for the 6 month period, the forward exchange rate is lower than the spot exchange rate, right? It's lower. That's why the US dollar sells at a discount, right, for that maturity. For the Aussie dollar, the conclusion would be opposite, right? Because we have only two currencies. Currency X sells at a premium, meaning currency Y selling at a discount. That is the only way to go. Like I said, if one currency goes up, the other must be going down, right? It is exchange rate. That is the beauty of the exchange rate of the forex market. Easy to make two conclusions with one number, you know, because you have two currencies. So making use of that logic, you can give the answer to Passy this way. The Aussie dollar sells at a discount for the 1 and 3 month maturities and a premium for the 6 month maturity. Okay? And finally, the calculations. So similar way, and let me just focus on one of them, right? And let me explain one of them, and then you know what happens to the other. Let's say the middle one, the forward premium for the US dollar. For the US dollar, for the 3 month maturity. Am I right? The equation says I need to find the difference between the spot rate and the forward rate, and then divide the difference by the spot rate itself, right? The difference divided by the spot rate, and then I convert, and the other way to say that, and then I annualize my answer this way, right? Making use of this conversion. So basically, the forward exchange rate minus the spot exchange rate, whatever I have, divided by the spot exchange rate, and then I convert my answer into 1 year. Okay, remember this is for 3 months, correct? This is for 3 months. And in 1 year, I had 360 days. In 3 months, I had 90 days. So I put 360 and 90 in my calculation. Well, in some textbooks, they say 365, and 3 months. It depends on what months you talk about, right? If you go from, for example, July to September, you have 92 days, correct? 92 days. And then you have to add 2 business days, making it 94. Okay? That's fine. If you want to go that way, it doesn't matter, because the answer will look exactly the same. Why is the same? Because of the small number rule, am I right? It will have some different numbers at the very end, but as long as you stop there with 4 digits, you will see the same thing. Anyway, okay? So in the exam, it's up to you, but I make it easy that way. 3 months means 90 days. Okay? 1 year, 360. Making things simple. Okay? But if you are curious, because you do other units, they have different formula. 365 days, and 94, 92, even 88 days, doesn't matter. Okay? It's up to you. Alright, so that is the answer to the last part of question 3. Any questions? All good? So we have offered those extra problems in such a way that the level of difficulty would be the same. Okay, so in the exam, you might expect some version of extra problem 1, some version of extra problem 2, or some version of extra problem 3. Okay, because they deserve the same attention. They will require very much the same amount of time to work on them. Okay? So prepare very well for that, and in the exam there will be no surprise. Okay? That's my promise. Of course, that's not the only problem set, am I? We have a few more. So today we do topic 2, part 2. We have another problem set, and at the very end, you see some extra problems as well. And those extra problems will serve for the purpose of examination, mainly. Okay? Of course, also practice, right? Another place for you to practice. We don't have that many, so that is the good thing about this unit. At the end of the day, if you add up the extra problems, you have something like a little bit more than 10 questions, maybe more than 15. And then you will see at least 4, right? Similar questions in the exam. So you practice all of those. If you're comfortable with these problem sets, you know how to solve them by yourself. You should get a very good mark in the exam. Okay? In the exam. Good. Okay, so let's move on with topic 2, part 2. So our focus for this lecture will be the balance of payments for a country. Okay, for a country. So it's not the balance sheet of a business firm. It's similar, but not exactly the same. Okay. Remember, this is for one country, so you put everybody on the same boat, right? And then you figure out the total number. That is the idea. But of course, if you work for the ABS, there will be millions of thousands, millions of transactions, right? That you need to take care of. But for our purpose, we don't have to travel that far. We just need to understand the mechanism, right? And how those entries occur for example, the case of Australia, right? Any country, you should expect to see similar stuff, by the way. So this is the plan. So when we're talking about the balance of payments accounts, we'll look at the structure of a typical balance of payments for one country. Then we talk about the double entry accounting system, which is familiar, I guess, to many of you. But remember again, here is for one country in relation to the rest of the world. Okay? So what we are talking about concerning the double entry accounting system is related to international transactions. Okay? Transactions between people from one country and people from another country. All right, so you will see some differences. And finally, when we're talking about the relationship between the balance of payments and national income accounting, as well as the forex market, the reference, as you can see, chapter 3 from the text, and some other materials. And those other materials can be downloaded from topic 2 folder. So I show you. And my recommendation is that you take a look at them when you have the time, because from time to time, so e-reading, right? E-reading, if you hit the e-reading, the system will take you to the place where you can download what we call other materials, right? Listed on the lecture slide, on that particular page, right? We follow that structure for the entire trimester, so you see the exact thing. Next time when we go, sorry, not next time, but into week 5, hopefully, when we go to topic 3, you will find the similar link, e-reading link. It is where you can go to download the other references apart from the text. Okay? Now, the ABS documents, right, the last 2 on the slide, they are a bit dated. Okay, they are a bit dated, but based on my experience, right, I've done a lot of search, trust me. I I think they are still among the best documents, okay? If you want to save a lot of time learning about the balance of payments, they are short and precise, okay? And remember, at the end of the day, the balance of payments principle, it is coming from the IMF, okay? So the whole thing will be after what we call the balance of payments manual within the IMF, okay? So IMF has the balance of payments manual. Basically, it is a guide for member countries to record international transactions, right, in a consistent way. That is the expectation. Because if Australia does it this way, Indonesia does it that way, it's very messy, correct? So we need consistency. That's why IMF provides the framework, okay? And IMF is requesting countries to follow these instructions so that the numbers will look easier for policy purposes, for statistics purposes, and so on. All right. So the manual is a big document, more than 400 pages, I think, and in small font size. So it's not recommended that you take a look at that document. I'm not going to recommend you to it's free to download, by the way, but I'm not suggesting that you do that because it will be very, very time consuming. But if you are interested, why not? Give it a go. But at the minimum, well, not at the minimum, but the only recommendation I would give is to take a look at appendix number 9. Sorry. So by the way, the latest BPM from the IMF, okay, International Monetary Fund, all right. So the latest version of the manual is version number 6. It has been out for a few years, but still being used, I think the most up-to-date one. And if you have the time, right, again, it's not recommended. Even that appendix itself is also a very long document. Appendix 9, okay. Again, it's not required for the unit, but if you are curious, how do I move on from those structure, then you might want to take a look at appendix number 9, for example, right? Eventually, in a few minutes, we'll talk about the current account, right? And we will say that within the current account, you have goods and services, correct? And then, whenever you have export, you have a credit entry in that particular category, okay? Goods and services. Or maybe goods only, okay? And services only, am I? For example, if you travel to Japan and buy something, right? Then we have an entry in the balance of payments for Australia because you have an international transaction. And it might go to the services area of the current account, correct? Because it is traveling. Even if you buy a camera, it is part of your holiday package, am I? So they will, IMF treats that particular transaction as part of services. But then he would ask, well, but it's too general, right? Services can mean a lot of things, correct? So how about we make it in more detail? We don't have the time to do that, okay? But that document has a lot of time. So if you are curious about that, more details, they have sub-level of classification, okay, of those accounts. So they go for 4 or 5 more levels, but we don't have the time to do that. So we only stop at the basic category, okay? So for example, within the current account, we have goods as a subcategory, and then services. That's it. We won't go further down, okay? That's a lot. There are a lot to do more, okay? We don't have the time for that. All right. So that is the reference. This document from Krugman and Ostfeld, they are famous trade economists, as you know, and they are also short and easy to follow. they have some examples, very useful examples as well. All right, some motivations. So by the way, when I teach, right, I don't want to say this, but I have prepared 2 sets of slides. They look exactly the same. But for teaching, I have a similar one, but go point by point. Okay, so you don't need to ask me for a copy of this because they look exactly the same, like the one you have printed. Now I just have more slides because I want to put them one on one. Okay, I want the points to appear one by one, so it's easier for me to focus. So some motivations. So this is an example, right? So is this the same one? Oh, so this is from last time. Sorry. That's why I'm so surprised. I have a lot of words in that slide, and it's not there. Okay, this one. So the exact thing, right? And now I move on. I go, one by one with my points. So let's start with some motivations. China, as you know, is a very good example. A typical economy that has transformed itself from a poor country to a rich country very much, am I right? So from time to time I had to talk about this macro thing a lot because I've been involved in, we call them executive education, teaching in government delegates programs. So I like this kind of macro issues, but they are quite interesting, right? So if you look back at the history of China, especially China's economic development, it is massive, it's very, very impressive, am I? You cannot see the same thing again very soon because it's remarkable. So China has experienced a massive economic development process, correct? Over the last many, many years, at least since reform in late 70s, right, up to now. Still very high growth, even though now it is trending down a bit, but comparing to the rest of the world, it's still massive, correct? You don't expect Australia to grow at 5-6%. You don't see that, right, for OECD countries, because we have reached certain level of development. We cannot continue with 6-7% per year. We cannot do that, am I? 2%, 3%, they are already a lot, okay? But for China, 5-6% is not enough, right? They are talking about a lot more, 7-8%, right? And it used to be 10% per year. That is very significant. And because of that massive economic development, China exported a lot of products to the world, correct? And that is famous. Most of the products are made in China, as you know, am I? You see China-made goods everywhere, am I? So the idea that China exports a lot of goods and services, not services, goods to the rest of the world, okay? And when China exports a lot of goods to the world, China is in a position to accumulate foreign assets, correct? But before that, we know that when a country exports a lot to the world, right, and it doesn't import that much, then the country will end up with what we call a current account surplus, okay? A current account surplus. That stands for the case when a country exports more than imports, okay? If China exports a lot and imports so-so, then China will end up with the current account surplus. And that is a good thing, am I? That is a very good thing. That is what we aim for, right? Every country tries to export as much as they can. That is the principle of economics, okay? The more you can export, the richer you become, okay? So the surplus in the current account is a fantastic news for China. And if you take a look at the reserve assets for China, it is also remarkable, right? It used to be small. Remember, before China, we have Japan, right? Korea as well. But Japan also impressive, right? Because of the automobile industry, correct? In the 60s and 70s, Japan emerged as number 2 economy in the world, right? Just because of the automobile and many other and also the manufacturing in general industry. Okay, they exported so many cars to all over the world. Okay, and they ended up with similar situation at that time. They accumulated a lot of foreign assets. Reserve assets for Japan was number one in the world during that period, but not anymore, because at the moment China is number one. Okay, China has recently I have checked, and it seems China is having about something like 3 trillion US dollars in reserve assets, or a little bit more, a little bit less. The number fluctuates, am I? Japan number 2 in the world still, but it is having around $1 trillion. Okay, so comparing to China is nothing, but Japan is to be number 1. But the good thing is, not good thing, but the trend has changed a bit. Nowadays, reserve assets for China become quite stable. Okay, it used to be on an upward trend, right? Very, very quickly, rising quickly, because China exported so much, and then so much income were spent in foreign assets, right? Chinese people or Chinese central bank, they bought a lot of assets around the world, in particular from the US. Okay, they have a lot of US Treasury bills, which is a short-term financial assets, and also US Treasury bonds. Bonds are a little bit more long-term, like 10 years, 20 years, but bills they are shorter. Okay, so China accumulated a lot of assets from around the world, and this is clearly a good news for China, but that good news comes at the cost of other countries, right? Because the US is the opposite here. If you take a look back in the last 10, 15 years, you see that US imported a lot of goods from China, okay? And US ended up with an opposite situation, which is called current account deficit, okay? Current account deficit. So US ended up with current account deficit, meaning US imported too much but exported too little. Okay, that is another way to look at it. Okay, or roughly speaking, US imported more than exported. Okay, precisely. So that's the way for you to end up with a negative balance. And clearly, it's not a good news. Right? You cannot do that forever. Right? You can do that for a few years. That's fine, but you cannot keep on with this thing forever. You cannot keep importing without exporting, right? Eventually, you will run out of money, correct? When you import, you have to make a payment, right? If you don't pay, somebody will need to pay for the import, for the product, right? You cannot buy a car without paying, right? From Japan, for example, someone will need to make the payment, right? Either you or your family or the government, okay? If you walk away from the debt, the government will need to take care of what you buy. Okay? So deficit is not a good news, because eventually it will run out of money. It will be in trouble, economic crisis. So account deficit, current account deficit is not a good thing from the macroeconomics perspectives, because that is related to national debt, all right? National debt. And if you look at in the US, they have the so-called debt clock, okay? US debt clock. And they have live numbers going up very, very quickly, okay? At the moment, you can go to that, to Google and search for the US debt clock. You will see the numbers. At the moment, US debt number is something like more than $22 trillion, okay? $22 trillion. US GDP is about how much? About 25, right? 24, 26, something like that, am I right? $25 trillion. And the debt level, the national debt level, is more than $22 trillion. So very close to GDP, okay? Very close to GDP. So it is not a good news, am I right? It's not a good news, because you have to reduce the number. You have to bring the number down. Debt, too much debt, you cannot do anything, right? You don't have money for the economy, because you only need to worry about is debt payment, debt repayment. You know, you have to pay back, because the debt they come with interest rates, and it's not free, am I? It's not free. It's not like official development assistance in developing countries, right? Sometimes you have 0% interest rate, but debt here, it is very expensive, and it is not a good news. At the end of the day, I guess what's relevant for the lecture is that as long as you have debt, right, deficits, in particular in the current account, somebody will need to pay for the deficit. Okay, somebody will need to pay for the deficit, and you cannot do that forever. And what might happen in the case of the US is quite obvious. One way for you to pay for the import is to use up the foreign exchange reserve, okay, or reserve assets. So you export assets to the rest of the world, okay, in order to finance for the import. You can do that, okay, as long as you have a lot of assets. But if you do that again and again, eventually you will run out of reserve assets. That is a problem, okay. And even if you follow the economic analysis of the national debt, you will see that even China, okay, $3 trillion, that's a lot, am I? But if you have some chaotic events like the Asian financial crisis, that amount is tiny, okay? It's not enough to get away from the crisis, okay? Like Thailand, the Philippines, Malaysia, right? They used to experience a 50% or even more 50% or more reduction in the value of the domestic currency, okay? And as a government, you have to use reserve assets to defend it. But what if you don't have enough money, am I? So $3 trillion, not that massive. Question?
What kind of assets are exported?
So, question here, what kind of assets can US export to foreign countries? Anything, okay? For example, bonds. US bonds, US treasury bills, okay, they are assets. They are made in the US, okay, if they can do that, right? They can sell those products to the rest of the world, and in return, they can import goods and services, okay. Other thing is gold, for example, okay, gold. If they have a lot of gold, they can export some of the gold to finance for their consumption. That's fine, okay. Or other currencies, right? IMF, they have the so-called SDR, special drawing rights. There is also one kind of currency. We call it IMF asset, okay. US can also export those things in order to finance for the import. And also other currencies or assets denominated in other currencies, am I? US also have assets around from all over the world, okay. And they can reduce the holding of those assets. Foreign government bonds, for example, right? They're not just selling their bonds, they're also buying, okay, for their macro policies. So they can cut down the holding of those bond levels in order to finance for the excessive import. Okay, and those experiencing the current account surplus, like China, can enjoy the good time because they keep accumulating assets from all over the world. Okay, but of course you have to think about whether or not those assets can give you good returns, right? If you buy things like the debt obligations products, right, related to the housing market in the US, for example, right? In topic 7, when we talk about the crisis, it may not be a good thing to do. Okay, you keep very, very risky assets because there's no guarantee of a good return. So you got to be careful with that as well. But anyway, as long as you have a surplus in the current account, it's a good news. You should enjoy it. All right, so let's take a short break before we move on. So, like I said, this is the focus of today's discussion, the balance of payments. So let's define the balance of payments for a country. So the balance of payments is defined this way. It is a statistical record of a country's international transactions over a certain period of time, presented in the form of double entry bookkeeping. So a few things, but at the end of the day, if you think about the concept, right, it is quite transparent. It is a record of a country's international transactions, right, over a period of time. So if you have domestic transactions, for instance, right, what we do with each other, our transactions, if you go to a coffee shop and grab a coffee, that transaction will not be recorded, am I? Because it's not international transaction. So that is the difference. For a balance sheet of a business firm, right, it's a different story, right? You have to record everything that when the firm operates and it is dealing with the firm. Here is different. We only care about international transactions. So international transaction means what? They mean you have transactions with foreigners, or you have transactions in foreign currencies. Okay? As long as you have some international elements in the transaction, then that is going to qualify to be part of our game, okay? Part of our record. So ABS, we need to keep track of that in the case of Australia, okay? International transactions. And they will be presented in that double entry bookkeeping. And again, I get back to that in a minute, but it will be similar to that for business firms, right? You will see some similarities. By the way, so the term was invented by the Italian, right? Like we talked in the first lecture a long time back. They were number one player in global finance, and they invented this term, this rule, and it is a very powerful one. And we will have to do that again and again within this discussion. And we have a lot of practice, right? So when you first see the concepts and see our conclusions, things might not be that transparent, but if you do some practice, it will be easier to understand things. All right, so transactions, what do we mean by transactions? Precisely international transactions, right? But as long as you are clear that we are dealing with international transactions, that should be fine. So transactions imply an exchange of values, right? You exchange something for something else, right? You sell a car, you export a car in order to get money, okay? You export mining products to China in order to get some money from China, am I? That kind of idea. Or you run a financial service to a foreign client in order to receive some income in the form of a foreign currency, for instance. So basically, we have a lot of examples, right, that can qualify, but here is the simplest one, export, right? If you export something, forget about the payment, right? We know that at the end of the day, transaction means two ways, trade, correct? You give somebody something and they give you something else, okay? But at the end of the day, the nature of export is the moment you export a car to a foreign customer, right? That is the nature of the transaction. And that nature of the transaction is going to give you a claim on that foreign guy, correct? Because look, at the end of the day, it takes a lot of time and it costs a lot of money, right? In order to produce that car. You're not going to give it for nothing, am I right? So when they sign the contract buying the car, it means you export the car to a foreign client, to a foreign customer, you deserve a payment, okay? You have a claim on the foreign company or person, correct? So you have a claim on, in general, the rest of the world, on somebody else, on somebody from a different country. Okay, and don't worry about credit, debit, get back to that in a minute, but for now, just an example, right? And of course, you can have import as well, right? Import is when you buy something, and don't forget about the payment. You need to make the payment, right? You cannot import a car from Japan for free. It's not going to happen, correct? You need to make the payment. So if you import a luxury car from Japan, eventually, you will need to make the payment, or somebody else will need to make the payment, okay? In that case, a Japanese automobile company or car maker will have a claim on you, okay? They can request the payment in the future. And international transactions imply transactions involving residents of different countries. Okay, and here is an example shows between people living in the same country. They will not be recorded in the balance of payments because they are the pure domestic transaction, right? They are not international transaction. There's no foreign residents involved. So if you have domestic sales, it's not part of the balance of payments. And this is also quite unique. The balance of payments is a flow statement, right? It's not like a balance sheet of a business firm. It is a flow statement. So what it means is that we only care about a certain period of time. What happened between, for example, beginning of the year and end of the year. Okay? We don't care about last year. We don't care about subsequent last years. We don't care about the future. Okay? We all focus on this year. So at the end of the day, it is important in the sense that looking at the numbers in the balance of payments, you have completely no idea what happened before that. Okay? You cannot link to the performance of the economy before that. Okay? For 2018, for example, looking at the balance of payments for Australia in 2018, you have no idea what happened in 2017. Okay? You cannot infer anything. You cannot conclude about reserve assets holding of Australia in 17. You cannot link to that. Okay? There's no connection. So the balance of payments is for a certain period of time only. So that is unique. Of course, if you roll over, right, from 20, 30 years ago, and you look at every single year, you can add up the numbers, right, in order to figure out how much foreign assets Australia is keeping. You can do that. But if you look at just 1 year, you just cannot figure out that information. Okay? And the balance payments keep track of a country's payments too, and its receipts from foreigners. Payments to foreigners will enter the balance payments as debit entries. Okay? So the idea is that if you import cars from Japan, right, the payments for the cars, right, that is something you need to make, correct? So car import is considered as debit in this case. Okay, it is the conventional way to look at this. And we use the negative sign for those debit transactions. Okay? Sorry, for those debit entries. So later on I will show you the balance of payments for Australia. You will see what I mean. And here's an example, right? An Australian firm imports a car from Japan. The Japanese firm has a claim on Australia. This claim enters as a debit. Okay? And the direction of fund economic value in this case is from Australia to Japan. You are importing a car. Okay? We haven't discussed the payment, right? The payment can go in many different ways. But for now, that import activity will appear in the balance of payments for Australia as a debit. Okay? As a debit. Because the direction of values, right, will go from Australia to Japan. You are buying. Okay? You are buying that product. That is owned, developed, produced by the Japanese. Right? It took them a lot of time to build the car, to manufacture the car, and send the car here. Okay? You have to pay for that. You are buying that value. So direction of values, right, the nature of the transaction is that it is adding to the Japanese economy, not to Australian economy. Okay? It is adding to Japan. So you are sending some values from Australia to Japan actually when you import the car. Okay? That is the nature of the import. So import means debit. Okay? Just keep that in mind. That is very important. And export means credit. Right? If you export, it's the opposite. If you export something, you get values from foreigners. So exports will enter as credits. So receipts from foreigners, right, like the case of export, as I said, they will enter the balance of payments as credit entries. So all of those receipts from foreigners. And the sign, the conventional sign is positive. Conventional sign for debit is negative, like I said. And for credits positive or no sign, right? No sign means positive. A number means a positive number. You know what? If you have a negative sign, that means a negative number. All right. And this is an example. Australian firm exports sugar products to China. It has a claim on China, technically. And that export activity means a credit. Okay? It is a value generation. It is an addition to Australian GDP. Right? It is the direction of values from China to Australia. Is that okay? So credit. So at the end of the day, this is the fundamental rules in the when we talk about the balance of payments entries. So keep that in mind for future reference. Export, credit. Import, debit. Whatever you export, whatever you import. Okay. And double entry bookkeeping, that rule says an obvious thing, right? Every economic transaction, precisely international economic transaction here, must enter the balance of payments twice. One as debit and one as credit. Okay? So eventually, we'll be talking about a lot of different types of transactions. So at the end of the day, we have to make a conclusion. Okay? What kind of entries do we produce? Do we produce any entries in the balance of payments? So the answer could only be no entry. Right? For example, domestic transaction, right? No entry, completely no entry. If I send something to my friend in Sydney, right? A birthday gift, nothing will be recorded here. Okay? If the exam question produce the following entry for the balance of payments for Australia, a guy sends a gift to his friend living in the same suburb, no record, okay? No entry. Because this is a pure domestic transaction, am I? Alternatively, we have transactions with foreign residents. We will need to show the entries, and we will always need to show two entries, okay? Debit and credit. So either no entry or two, okay? Never show one. So that is balance of payments environment. And because of that, technically, the balance of payments is always in balance, okay? That is the nature of the balance of payments. It is always in balance, meaning if you add up the numbers, you have a zero sum, right? Because credit means a positive number, debits negative numbers, right? Because they appear, every transaction will produce two numbers, one positive, one negative. If you add them up, you have a zero sum, right? So technically, if you add up all the numbers in the balance of payments, you should have zero. But in reality, it's not like that, okay? Because in reality, the numbers, they appear in the balance of payments for a country in a different way, right? The transaction, so by the way, IMF's rule is that as long as the ownership has changed, you need to make the record, okay? So the record, the moment when to put the record, when to make the record in the balance payments, it is when there is ownership change, okay? That is the rule. So if you export a car from Japan to Australia, the moment the car leaves Japan, okay, that is when you have the ownership change, okay? So it is a change in ownership from the Japanese company to the Australian resident, for example, okay, ownership change. And that's why in international trade, we have the concept of bill of lading and things like that, okay? That is the record of the moment when the car leaves Japan for Australia, okay? The same for the other way around. Okay. And again, you have to make the corresponding payment for that transaction, right? Whatever you buy, you need to make the payment. The payment, however, will not go through the same channel, okay? The car will go to Australia through the sea channel, right? Through the customs office, for example. The payment will go through the banking system, correct? And that is a problem. It's not always the same, okay? The moment the car leaves Japan, and the moment you make the payment might be different, right? And remember, money has opportunity cost. If you make the payment today and the payment tomorrow, you have to deal with different amounts, correct? Because clearly leaving money from today to tomorrow will cost you certain amount of money, okay? So that is the idea of opportunity cost in economics. If you hold some assets, don't think that it is free, okay? Overnight, it generates some value. So because of that, when the payment is recorded, the values might change. Not to say that it's not correct, okay? Because like I said, even in very famous organizations like Barings, okay, mistakes were recorded, customers requesting buy orders, and traders put in sell orders. Okay? Things like that can happen. So a lot of discrepancies can be observed here. If you do the two numbers at the same time, then it shouldn't be a problem, correct? But here, unfortunately, export and payment, they go through different ways, different channels at different times. So clearly, they might not match at the end of the day, especially when you have millions of transactions in 1 year. Okay? There's no way you can guarantee that you have a zero sum at the end. Right? I know that in IBS, there's a team. Okay? I have friends working there, and I know that there's a team trying to reconcile the numbers so that they match. But still, so the idea is at the end of the day, right, there will be some discrepancies. And that team's job is to bring down the discrepancy to zero. But they can never do that. Okay? Still, the numbers are sitting something like, for Australia, for example, you see a few hundred million dollars as the difference between these two activities, right? The sum of the receipts and payments. They are always something like a few $100 million, sometimes $2 billion. Okay, can be positive or negative depending on what happens. Okay, but there are always discrepancies. So zero sum is in theory, but in practice, no. All right. So the balance of payments accounts will consist mainly of two components, right? The current account and the capital and financial account. So the current account is different from the capital and financial account in that the current account has got things like, goods and services, export and import, income from working overseas, dividend income and things like that, right? Or even transfer, forced donation, and gifts. The capital and financial account, they are completely different, right? They are all about money, about financial assets, about capital. Okay. For example, if someone migrates from a country to a different country and brings with him some money, okay, that amount of money will serve as capital transfer, okay, because the guy brings some money from one country and put that in a different country. So there's no import and export here, right? There's no car purchase, import, export, nothing. It's just money transfer, correct? He brings with him some money, and that is part of the capital and financial account. Okay, and a lot more. Anything with financial assets, right? If you buy shares of a foreign company, if you use your credit card to make to buy something overseas, for example, right? They are part of this story as well. And in practice, there are always discrepancies, like I said. So within the INET balance of payments, there's an instruction to put another component, right, in the balance of payments. It's called net errors and omissions. It doesn't have any meaning, okay? It doesn't have any interpretation. It doesn't contain any meaning at all. All that component does is to correct the difference between debits and credits. That's it. Okay? At the end of the day, if you add up the debits and the credits, you end up with a positive value, then there will be a corresponding negative value recorded in that component, net errors and omissions. right? So let me quickly show you the one for Australia. You can see what it means. If you do that, eventually you end up with something like this. Okay, look at the very last row, which is net errors and omissions for Australia. You see the numbers are always a few $100 million or even more than $1 billion. Now, if you add up the highlighted numbers, right, the balance on current account and the balance on capital and financial account, technically you should have zero, right? Unfortunately, you will never have zero for that sum, and because of that, the net errors and omissions will generate a new number that will be very helpful, because if you add that number to the sum, you will have zero. Okay, so that is the way it works in the balance of payments. So if you add up minus 52, 54, and one minus one something, if you add them up, you have zero. That is the idea. Okay. So there are three components. Two of them are the major components, and the last one is just to correct the discrepancies. Alright, and in Australia in 2010, for example, the current account balance was minus $52 billion. The capital and financial account balance was about $54 billion. Sorry, current account minus almost 53. Capital and financial account 54. And net errors and omissions around minus 1. Okay, if you add up these three numbers, you have zero. You have zero. So that is the benefit. Okay. But the last number itself doesn't have any interpretation. It's not import, it's not export, nothing. Okay. It doesn't serve any. It doesn't have any interpretation apart from helping us correct the differences between these two accounts. Okay, so let's take a close look at the current account. The current account consists of the following main categories. Goods and services, the first one, right? And you can subdivide it into goods and services. And like I said, if you follow the balance of payments manuals by the IMF, you can further subdivide it into other things, all right? And then subdivide. So a lot of divisions following these subcategories, but we won't do that here in this unit. As long as it is, you can justify a particular transaction as goods, that's okay, okay, or services, right? The second category is called primary income. Sorry, I should explain the rules again. Export, according to IMF, export will enter as credit and import debit. All right, so that is a fundamental rule you have to keep in mind. And primary income is defined as income earned by domestic residents from abroad or income paid to foreign residents as well. Remember, you can work in a foreign country to earn some income, but foreigners can come here to work and make money. So it's two ways, right? Depending on what you're talking about. So if you work in a foreign country to earn some income from abroad, then the transactions will appear as credits. And if foreigners, they come here to work, we pay them, then those transactions, right, will appear as debits, because the direction of values, right? If we work in a foreign country, it's like we are selling our ability, we are exporting our ability, am I right? So, and we deserve the payment. We have a claim on foreigners. So that is, we are adding to our economy, am I right? We are bringing foreign exchange to this country. So income earned by domestic residents from working overseas will enter as credits, and income paid to foreigners, right, will enter as debits. That is the rule. And within the primary income, you can have subcategories. Compensation of employees. So mainly you're talking about salary and wage, bonus, and things like that. Investment income as well. So this is a huge, correct? Investment income. It could be you buy shares of a foreign company and they pay you the dividend, right? Or you buy treasury bonds, right? Bonds from other countries, and you will receive some payment. Okay, so investment income is the name for that subcategory. So compensation of employees, mainly wages and bonus. Okay, so another category, as you can see within the current account, which is called secondary income. So primary income and secondary income. So primary income, working income based on working activities, right? Or investment activities. Secondary income is different. It's based on transfers. The nature of secondary income is transfers. For example, you provide some donations, right? You send books, donations to Indonesia, right? Or the Philippines. Then that donations will appear in the balance of payments within the secondary income subcategory. Okay? Foods, books, whatever, donations will qualify for this as well. So previously, in the previous manual version of the BPM, primary income was called income, okay, and secondary income was called current transfers. Now IMF makes it consistent. They call them primary income and secondary income. But we are not serious about that. In the exam, it's up to you, okay? Because still nowadays, some countries, they still stay with BPM 5. Am I right? They stay with that instructions still. So they produce current transfers instead of secondary income. So it's up to you. You can justify your transactions whatever way convenient. And secondary income can be part of general government's transactions or the private sector, right? Government or private sector. So donations can be made by the government or by business community or by individuals, right? So it depends on what happens. At the end of the day, these are the subcategories we expect you to understand. Not further down the track, because there will be many of them, and we don't have the time to do all of those. Okay? So make sure that you understand up to this level of classification of categories within the balance of payments. Okay? So this is the current account, and that's all we have. Okay? At the end of the day, keep in mind that export will give you credit entries, and import will give you debit entries. Okay, that is very important. All right, and a lot of transactions will qualify for the current account, and here is the list. You can see import and export again, right? A citizen of Australia receives dividend income from the US, or an Australian firm pays dividends to foreigners. Australia provides food aids to Indonesia. All of this, right? They are part of what we call the current account transactions. Current account transactions, right? So as you can see, they don't have financial assets, money involved. Right? We are talking very much about the nature of the transactions, right? Any question about the current account? Straightforward, right? Straightforward. At the end of the day, just export and import, that's it. And whatever it is, you need to find the corresponding categories and subcategories. Within the current account, you can produce some interesting statistics. For instance, you can compute what is called the merchandise account. The difference between export of goods and import of goods. Okay? So export of goods minus import of goods. It is defined as the merchandise account. Net services, similar way. Export of services minus import of services. Okay? Net income, so basically the net for these items, correct? So the balance, positive minus, you add up the numbers. You add up all the numbers, right? The debits and credits, whatever you have, right, is called the balance, correct? So the balance on goods, for example, right, it has the name merchandise account. The balance on services is called net services, and so on, right? So net income is simply the balance on income, and it is income earned by domestic factors from overseas minus income paid to foreigners. Net transfers, similar way, it is the balance on transfers, right? How much you provide to the rest of the world against how much the world provides to Australia. Okay? Good. Current account balance, at the end of the day, it is simply the balance on the current account. It is the difference between credits and debits in the current account. So the second component of the balance payments, capital and financial account. Before IMF separates these two, right? They had capital account and then the financial account in the previous manual version, but not anymore. So now they combine them because the nature of these two accounts, they are quite similar. Okay, they are dealing with money, financial assets, right? So that's why they should be put together. But really, it depends on how you look at this thing. Anyway, so the first category is obviously the capital account. Capital account will record these things: acquisition, disposal of non-produced, non-financial assets. For instance, you buy a license from a foreign company. Okay, you make the payment, you import that license, then that will appear here. Okay, so it's not a car, so it won't go to the current account, correct? So it is part of what we call capital account. So IPRs, trademarks, licenses, and so on. Okay, royalties as well. So they are part of this, and here the numbers are big. If you look at the number for most countries, you see they are in the order of billions of dollars. Okay, the numbers are quite big. Capital transfers, for example, due to migration, right, or donation of money. Australia can provide official development assistance to developing countries, correct? And that amount will go here. Well, of course, we are not talking about food donation, not about textbooks donations, right? Because textbook donations will go to the current account. But if Australia provides money as the donation, right, then that will appear within the capital account. Within the capital account. All right, and that is called capital transfer. And it's the same way, right? People moving from one country to another to live permanently. They bring with them funds. Then that will go to capital transfers. The second major component here is obviously the financial account. So within the capital account, the rule is such that if you have capital inflows, you have credits, and if you have capital outflows, you have debits. Okay? If people bring funds from like India, for example, to Australia. Now, from the Australian perspective, we have credits because we receive those funds. Okay? We do nothing, but those funds will be part of our GDP. Okay? So those funds will add to our GDP. We receive those funds. The direction of funds will be from other countries to Australia. Okay? So we have credits and debit for India in that case. Financial account, let's forget about the rule for a moment. So within the financial account, we have several subcategories. The first one being direct investment, like firms investing overseas, right? And the rule according to IMF is that as long as you have more than precisely 10% or more of the voting rights in a foreign company, that investment will qualify as direct investment. Right? In some countries, I know that it really depends on which country you're talking about, right? Because in some countries, 10% voting right is nothing. Okay? You need 50% in order to influence the firms, right? Like Australian banks, right? They used to buy, for example, ANZ used to buy 10-20% of a commercial bank in Vietnam, right? But that 20% that is a lot, correct? But at the end of the day, if you want to control that bank, according to the Vietnam's regulation, you need more than 50%. But unfortunately, ANZ cannot buy that amount, okay? Because by the Vietnamese law, they won't allow you to buy more than 30%, okay? So really, in that context, this 10% is a little bit tiny, correct? But at the end of the day, you cannot have different regulations to come into the same play. You need the common threshold, right? So as long as it's 10%, you qualify for this subcategory, according to IMF, because they make it 10%. And if it is not 10%, those investments will be part of what they call portfolio investment. It's not direct investment anymore, okay? Like indirect investment. You buy a small share of a particular foreign company. You're not interested in operating or in controlling the foreign company, right? You can buy bond, securities, whatever from a foreign company. Financial derivatives and other investments, they are there as well. So financial derivatives in topic 5, we'll get back to this concept. But basically they are options and futures contracts, okay? So, and also some other financial derivatives, okay? So Bitcoin or digital currencies still not yet there formally, okay? So people play around with that still because of the regulations, right? In some countries they accept it. I'm not sure about the level of acceptance is also questionable. But in many countries they are not accepted as a means of payment, okay? So still it's not at the global level. That's why there's not such things like that. But mainly options and futures contracts here, currency derivatives, a lot of products, right? If you go to the BIS statistics, right? When I mentioned the summary, the triennial surveys, they have those products as well. Other investment, this one's huge, right? Most of the transactions, eventually you will see that you have something to put there as well. For example, the simplest example is that you use your credit card to buy something from overseas, okay? So that the moment you use credit card to make the payment, you have a transaction to appear, you have an entry to appear within other investment. Why so? Because your credit card has things to do with loans and deposits, okay? They are your money. They are taking out, they are one way to use up your funds, basically, am I? So your deposit level will go down, okay, if it is a debit card. Make sense? So eventually you will see that even in the exam, okay, many transactions will involve entries within that particular subcategory, other investment, okay, other investment. Good. And trade credits is also very helpful. Nowadays, these products are very popular, right? Because if you have large transactions, foreign partners, they cannot make immediate payment, right? It takes time. So sometimes you have to grant them some trade credits, giving them a few months to make the payment, right? And that sort of thing. So they are part of this subcategory as well. In international trade, okay, very popular. And finally, reserve assets. So reserve assets, they are controlled by the central bank. The Reserve Bank of Australia, in the case of Australia, and the central bank in general. So they have transactions in the international market as well. And they have to do so for obvious reason, right? Policy making, and they defend the domestic currency. They cannot say no, okay? If you have a lot of foreign currencies, you can go to the central bank requesting them to convert them out into domestic currency. They cannot say no, okay? They are in a position to make that happen for you as a lender, as a last resort. So basically, reserve assets, they are transactions by the authority, okay? In most of the case, the central bank. If you if you put that element off the table, all the transactions in the balance payments will come mainly from the private sector, okay? From citizens in a country. But if you add the last thing, you add the authority, okay? So that's why the authority plays an important role here. They have a lot of assets, but their position is to make sure that the economy is in equilibrium, okay? If the people have so much foreign exchange, they can bring them to the central bank, okay? And the other way around, if people want to get rid of domestic currencies and they want to convert them into foreign currencies, the central bank will need to make that happen as well, okay? They are in a position to make sure that the forex market, the economy, the payment system is in equilibrium, okay? They have to defend the economy that way. All right, and similar to the current account, you can do a few calculations within the capital and financial account. Question?
What if a citizen of a country, they always start to buying, for example, US dollar against Australian dollar in Australia? What can Australian government do in order to not to let the Australian dollar to depreciate against you?
So the question is, suppose we have people, traders, speculators, keep buying US dollars, right? A particular foreign exchange, and he does that again and again, okay? And should the government or should the authority do something, right? So my answer is no, okay? Because one individual is very small in the market, okay? Even George Soros, okay, he cannot do that here, right? The reserve assets by the government, controlled by the government, it is massive, okay? So one individual is too small. So he cannot change the market in any way, okay? But of course, if you have too much speculation, not coming from one individual, but it's coming from many individuals, from organizations, right? Then clearly the government will need to step in, okay? They can do a lot of things. One way is to beat you, okay? Because like I said, they have a lot of assets, am I? If they think that the volume of transaction is not significant, they can make it happen for you, and at the end of the day, it won't change the market in any way. But if the volume of transactions is too big, right? So that is clearly a problem, am I? But don't forget that the government, they have monetary policies as well, am I? So they can play a lot of things against you, okay? For example, they can change the interest rate, okay? If necessary, they can change the interest rate. Yep. And at the end of the day, right? If it is massive, they can change the regulation. They won't let you do that, okay? They are the authority. They control, right? As long as they can maintain economic stability, they will do it, okay? But in the case of Australia, about 3 years ago, right? So the governor, the boss of the RBA attended an economics conference. Okay, at that time, the Aussie dollar was too high, about parity to the US dollar, about 95 cents. It was going down at that time from about 1.1, okay, to 95 cents. And the governor was saying that we all know that it is too high, okay? Everybody knows that the Australian dollar should not be 95 cents against the US dollar. The Reserve Bank is doing nothing, okay, because it's a free economy, it's market economy. We are not going to do anything now. But if the trend continues, okay, if the Aussie dollar does not go down, we will intervene. We will intervene, okay. And why does he say that? It is simply because RBA, they have a lot of assets, okay. They can bring down the value of the Aussie dollar. In topic 4, when we talk about government intervention, you see there are some tricks, some ways for the central bank to intervene in the market, to bring down the value of the currency, or of course to bring up the value as well, okay. So, but they have the tool to do that. But in some developing countries, right, the government can make some regulations against speculators straight away. But in the case of developed countries, OECD countries, right, like Australia, they don't do that, okay. But they can do that if necessary, okay. In practice, they don't. But even some announcement, right, some commitment from the RBA's boss that way, it is a signal to the market, as you can see. So actually, I put that question down as an exam question in the past. Right? Why did he say that, and what impact on the foreign exchange market would you expect? Okay, even just a saying, but it is a saying by an important person. Okay, the RBA boss, he has a power. He can do that if he wants. Right? So clearly, policy framework is important here. Okay, so sorry, I should have mentioned about the rule here. As well as you have an increase in liabilities to foreigner, right? The first one, increase in liabilities to foreigner or reduction in foreign assets, you should have credits entries to be recorded within the financial account. Okay, so whenever you have an increase in liabilities to foreigner or a reduction in foreign assets, you have credits. And why so? Well, a reduction in foreign assets, I think, let me explain that part first, right? So reduction in foreign assets means you use up foreign assets, okay? The other way to say that you export foreign assets to other countries, correct? You have a lot of foreign assets, and now because people within the economy, they import too much, you have to make the payment, right? You use up foreign assets. You export foreign assets to the foreign country to make the payment. Okay? So exporting means credits, correct? Whatever you export, financial assets, they are just something, right? Gold, for example, right? Think about gold as a foreign asset. The simplest thing, right, to think about. If people in Australia import too many cars from Japan, okay, and they request RBA to make the payment, okay, they bring in the Aussie dollar to the RBA, requesting RBA to make the payment on their behalf, for example, right? RBA can export gold to Japan to make the payment. Why not? Okay, gold has a lot of values. Am I right? So exporting gold is a reduction in foreign assets. Okay, it is the reduced holding of foreign assets, and in that case, gold export when give credits, just an export. Okay, so even financial assets, they are credits as well. Does that make sense? So the fundamental rule at the end of the day is always such that if you have export, you have credit entry. If you have import, you have debit entry. Okay? Whatever you export, whatever you import. Gold, financial assets, cars, mining products, whatever it is. Okay? So reduction in foreign assets, it is simply an export of assets. Make sense? And that will give you the corresponding credit entries. Now, how about liabilities? Liabilities will be what? So, liabilities, the nature of liabilities will be also financial assets. Okay, financial assets. But it's not foreign assets. It's not gold, it is not Japanese yens, it is not US dollars. Okay, they are domestic assets. Okay, liabilities, domestic liabilities to foreigners. They are assets, domestic assets, in the hand of foreigners. Okay, foreigners hold our assets as well. We can hold their assets, right? We can hold foreign assets, and foreigners, they can hold our assets as well, correct? They can buy houses in Australia. You cannot stop them from buying houses in Australia for investment, right? They hold, foreigners, they hold Australian assets for sure. And that is our liability, okay? Our assets held by foreigners, they are our liabilities to foreigners, okay? Similar, just the opposite way. It's just a matter of definition, okay? So liabilities to foreigners, the nature would be simply domestic assets, okay? So foreign assets, quite obvious, foreign currencies, gold, IMF, money, whatever, okay? You can use those to make the payment. Domestic assets, you can use domestic assets to make the payment as well. And in that case, you increase liabilities to foreigners, okay? You tell them, look, that citizen, okay, just imported a car from your company, and now he has transferred certain amount to your bank account in ANZ in Australia, okay? That is our liability to you. You can come back to get that amount of money anytime you want, okay? It is in your bank account, okay, in Australian dollar, because it's a domestic asset. Can you see the difference? Of course, the guy can simply send $20,000 to Japan to clear the payment. In that case, it is a reduction in foreign assets, but he can as well make a money transfer to the bank account of the Japanese firm in Melbourne. Why not? Am I right? And that amount is in Australian dollar, domestic assets. So the justification for that case can be an increase in liabilities to foreigner, because look, it is money in the account of a foreign company, okay? It is in the hand of the foreign company. The foreign company can have access to it anytime it wants, all right? Now the opposite is also true. A reduction in liabilities to foreigners will give debit entry and an increase in foreign asset obviously will give a debit entry as well. It is like an import, okay? We import some foreign assets. From Australia perspective, for example, if we increase the holding of foreign assets, we are importing foreign assets, correct? We have some more. We are importing some more gold. It's clearly debit, am I right? And reduction in liabilities, right? Reduction in liabilities is what? The foreigners, okay? So the Japanese firm, for example, right? He is having a bank account in Melbourne, ANZ Melbourne. Now the company is taking out the fund, okay? They are taking out the fund. Before it was, let's say, $5 million. We are responsible for that $5 million deposit, correct? Because it is Australian dollar, but in the hand of the foreign company. Okay, it's not our money anymore. It is that guy's money, right? That foreigner's money. And now he decided to take the amount out of Australia. Okay, he takes out $5 million. So we are not responsible for that $5 million deposit anymore, am I right? Our liabilities to foreigners will go down, correct? Will go down. So it's similar to exporting as well, because we are exporting some assets to the foreign country, okay? So it's similar to, so we are talking about the second, right? So reduction in liability, in that case, is similar to importing, okay? We are importing back certain liabilities, okay? We have, before we were responsible for $5 million deposit, and now nothing, okay? We are getting that back to Australia, okay? We are importing that liability, that amount of assets back to Australia. So it is like similar to an increase import, an increase in foreign assets. Okay, same thing. Okay, let me go through this conclusion again one more time. So as long as you have an increase in liabilities to foreigners, then you will have a credit entry similar to a reduction in foreign assets. Okay, and if you have a reduction in liabilities to foreigners or an increase in foreign assets, you should have debit entry. Okay, and at the end of the day, I think I already explained this. Assets and liabilities, they mean the same thing. The only difference is that Liabilities mean somewhat domestic assets. Okay, assets held by foreign residents. Okay, domestic assets held by foreign residents. Right, houses here, for example. Okay, they can buy houses in Australia to invest. So they are in the hand of foreigners. And liability, that is our assets, right? And foreign asset is simply assets in a foreign country in our hand, okay? In our hand. We have the control of that. In our ownership. So, a liability is the other way to say that liability is simply a financial claim of the rest of the world on the reporting country. And foreign asset is our claim, our financial claim on the rest of the world, okay? On the rest of the world. And like I said, you can do a few calculations within the capital and financial account. And this is probably an important one. The net international investment position. Okay? At the end of the day, it is simply the balance on the financial account. Okay, financial account. So if you add up all the debits and credits within the financial account, you end up with a number, and that number is called net international investment position. Okay? If it is positive, what does that mean? If you have a positive number for this term, right, for this sum, it means what? Positive means export, correct? Export means a reduction in foreign assets, okay? If you end up with a positive number, it means you have actually reduced the holding of foreign assets. Or the other way to say is an increase in liabilities to foreigners. You sell domestic assets to foreigners the same way, okay? And if you have a negative number, it means what? You import too much foreign assets, okay? But that's not a bad thing, right? Because at the end of the day, why? You have to ask why. Could be because on the other side of the coin, the current account, you are performing very well, okay? You have a huge surplus in the current account, and that's why you can accumulate foreign assets. Why not, right? Like the case of China, right? Capital and financial account, in particular reserve assets, the number is big. The number is big, right? If you have a trade surplus, for instance, you can keep accumulating foreign assets, no problem. It's good actually, okay? Because assets mean income, future income, right? So assets will not like goods and services. They stop when you consume them, but assets will have future income attached to them, so it's a good thing. And we have a lot of examples here. Again, Australia, the Australian government forgives $100 million debt owed to it by the government of a developing country. Okay, debt forgiveness, which might happen, right? Because Australia provides donation, right? Development assistance, in particular, to many developing countries, right? One of the 28 DIC, the donor countries, the largest donors in the world. It's called the DIC Club. Okay, 29 members. Australia is there. So you have Japan, Germany, right, and the US, of course. They are important players, and Australia is there. So normally those DIC countries, they provide development assistance to the rest of the world, mainly developing countries, low-income countries, right? And from time to time, they can end up with agreements saying, okay, so you can ignore that amount. Okay, we don't need the repayment anymore. Okay, given the problems, macroeconomic problems, we can just get rid of that debt for you. Okay, sometimes it happens that way. Okay, then it will have an entry in the balance of payment, and in this case, debt forgiveness will show up in the capital and financial account, and precisely it will be part of capital transfers. Okay, and you should take a look at the first the first material on top of the textbook I mentioned in the reference slide. It has got this example from the book, right? Krugman and Oswald. They have the debt forgiveness example within their story. A citizen of Sydney buys shares of IBM company in New York. Okay, so it's clearly an international transaction, and purchasing shares, it will either go to direct investment if that is a lot of shares, or portfolio investment if it is a small amount. Okay, a small amount, depending on the volume of the transaction. CBI uses its deposits in the Bank of America to purchase $1 million worth of short-term US Treasury bills. It can happen, am I right? So commercial banks in Australia, they buy US bonds or bills. Okay, the government bonds and bills is one way to minimize the risk, right? And they can do that and maximize the returns as well, depending on the time. This transaction is clearly part of the capital and financial account, am I right? Because it's bonds and bills, that sort of transactions. Good. So comparing between the two, capital account and capital and financial account, current account and capital and financial account, what do we say? What can we say? What do we conclude regarding the differences between the two? Well, at the end of the day, the current account is all about goods and services, right? And income factors, for example, working income, bonuses, investment income, am I right? Or even donations, transfers. Capital and financial account is different. It's all about what? Money, financial assets, capital, and things like that, correct? So clearly, they're not the same thing. And one way to talk about the difference is based on the nature of the goods or services or the product within those accounts, right? So the current account in that context deals with real assets, physical assets, real assets. And capital and financial account deals with financial assets by nature. Another difference, this one is easier, I guess, is that the current account includes transactions that influence the balance of payments in the reporting period only, in the current year only. And the capital and financial account includes transactions that affect the balance of payments in the future as well. Okay, current and the future. So think about financial assets. Like I said, there's always the return on investment that you have to think about, the opportunity cost of money, right? So if you invest, you should expect some returns on investment. That's why one reason why you have, for example, official development assistance that will go to capital transfers instead of the current account for this reason, right? Because that loan provided by the government of Australia to a developing country, for example, will have future payments attached to it, correct? It's not free loan. The loan has, it might have a low interest rate attached to it, but that is a payment that will happen in the future. Okay, that will happen in the future. Good. Again, debt forgiveness. Take a look at this document, which is one of the online reading documents for the example. So balance of payments identity. So this is important, right? If you sum up the numbers in the balance of payments, technically it should have 0 by nature, right? You have 2 entries with opposite signs. So clearly it should have a 0 sum. In practice, no, of course, but let's forget about the reality. Let's talk about the equation. The way the equation is designed is that you have the sum of these accounts to be 0. Now, here you can play a bit with the equation, keeping in mind that you have reserve assets as very important item within the financial account, am I right? And like I said, reserve assets, they are transactions made by the central bank, okay? And the main objective of those transactions is to balance the economy in a good way, okay? So the central bank has to make sure that the payment system is in equilibrium, okay? How about we set aside their transactions, okay, and see what happens. So one way is that you can play with the system with that equation. So it's better if I make it clear, otherwise a little bit confusing. So current account plus capital account, right? And then you have financial account, correct? Plus financial account. The sum has to be 0. Good. Let me play with that equation a bit, because I know that within the financial account I have reserve assets, right? That is in the hand of the central bank. So let me copy the whole thing and rewrite the equation. I know that reserve assets is there, so let me take away that component. Can I? And then I add that up again. So technically I haven't done anything, correct? I subtract something and then add it up again. So no change to my equation. But the benefit is this: I can combine these two. You will see a new thing. Okay, if I incorporate reserve assets and my financial account, then I have something very interesting, because now the financial account will not have government transaction, will not have the central bank's transactions anymore, correct? So that brackets, the thing inside of my brackets, will be the financial account still, but without the authorities' transactions, correct? Yes? And then I can bring this thing to the right. I can bring reserve assets to the right hand side of the equation, can I? So I can do it this way. I can bring it to my right hand side and change the sign of the thing. Okay, and I'm done. Yes, all good, right? So what is my left hand side now? My left hand side, if you look carefully, my left hand side is the sum of everything in the balance of payments without the authorities' transactions. Okay, debits and credits of the authorities, they are excluded, correct? What is my right hand side? My right hand side is a negative of reserve assets transactions, correct? So left hand side is basically everybody in the economy apart from the government, okay? And right hand side is basically the government only, am I right? And at the end of the day, when you do something like this, when you isolate the role played by the authority or the government this way, you can say that, look, left hand side is the private sector in the economy, right hand side is the government. So the government has to make sure that the economy is in equilibrium. The payment system is in equilibrium this way. So in the media, people call the left hand side actually the balance of payments. A little bit confusing, but it is the way in the media the term is understood. So left hand side is called the balance of payments in the media. Okay, in our language it's different. Balance of payments should be the whole thing, right? But in the media, unfortunately, they still call these things the balance of payments. And as you can see, the sum is not 0. The sum should be a big number. Am I right? And they translate that number as something that will need to be taken care of by the government. Okay? That is the only way for the economy to work. Am I right? Because the left hand side at the end of the day is the private sector. Okay? And that brings back to this thing. Okay, so if we do that, we end up with the same thing here. I just did the same thing. And the interpretation, left-hand side, is simply negative of the balance on official reserve. Right-hand side has a name for it. It is called the official settlement balance. Okay, official settlement balance. It is a number that the central bank has to look after. Okay, they have to take care of that amount. They have to take care of that number by reserve assets transactions. Okay, and at the end of the day, like I said in the media, left-hand side, right-hand side, this thing is called simply balance of payments. Right? Okay. Anything else that I should mention? All right. So omission I already mentioned. This is the balance of payments for Australia in the past, just for your information. And let's quickly talk about this example so that you understand the mechanism, right? So here we have an export of cars from Japan to the US. And the setting is concerning what might happen to the balance of payments for the US in this case, okay, as well as Japan, because that is the idea. So in this case, right, the Japanese firm Nissan has got a check, $20,000. That is the value of the car export from Japan to the US, $20,000. But Nissan doesn't like US dollar because Nissan is based in Japan, right? So at the end of the day, Nissan will need to convert that amount into Japanese yens. So Nissan brings the check to the Bank of Japan. That's it, okay? I don't like this amount. Can you give me Japanese yens? That is a question. And of course, the Bank of Japan has to make it happen. So the Bank of Japan is happy to convert that amount into Japanese yens. So the Bank of Japan will collect that check and increase the holding of foreign assets. Okay? At the same time, Nissan will receive the equivalent amount in Japanese yens. Okay? That is what I mentioned by this equation. Right hand side is coming from Nissan's transaction, and left hand side, the Bank of Japan. They have to do something to make sure that the payment system is in equilibrium. That $20,000 check is not going nowhere. It has to be in the hand of somebody. If Nissan doesn't want it, the Bank of Japan has to take it. Okay? Has to take it. Good. So the numbers are there, and if you take a close look at 2010, again, if you have the time at home, check my calculations, but I think it's correct. So basically in 2010, reserve assets in Australia about $6 billion. What does that mean? $6 billion. And the sign is positive, meaning what? Export or import? Export, okay? So why did Australia export that amount of assets to other countries in 2010? Because it had to do so to make the payment on behalf of Australian citizens, correct? Meaning what? At the end of the day, the rest of the economy ended up with a negative number, correct? With a negative number. Because technically, Australia imported too much. Okay? Imported too much. That's why the Reserve Bank of Australia had to make that payment on behalf of Australian people. Okay? The positive value has that interpretation. And let's check it. So if we add up the numbers for 2010 based on the last column here, you will see that the non-reserve portion of the capital and financial account, 48, current account, minus 52. So the official settlements balance is minus around $6 billion. Okay, minus $6 billion. So technically in 2010, Australia imported $6 billion more than exported. Correct? And at the end of the day, the Reserve Bank of Australia had to make the payment or not. Okay? Good. And let's quickly go through this so you can take a look at the problem set. So double entry accounting system is what is the focus for the next discussion. Let's go for another 5 minutes. So every precisely international economic transaction must enter the balance payments twice. One as debit, one as credit, depending on the nature of the transaction. Now, one way to think about it is that the transaction means an exchange of value. You export something to get something in return, maybe a payment or another good in return, but goods for goods, the bar exchange economy is not happening anymore, right? You export something to get a payment. So technically, an exchange of values, right? One value for another value. Sorry. Example is this. An Australian firm exports some products to China, the corn to China, and the Chinese firm makes a payment. So clearly an exchange of value, right? Corn products for money. So from an Australian perspective, that corn export is credit, correct? It is an export, so it's credit. And payment is what? Payment, whatever way it happens, it is an import, right? An import of foreign assets. For example, the Chinese firm makes a payment in Chinese currency. So clearly, it is an increase in foreign assets. It is an import, basically. So credit for the export activity and debit for the payment. All right? So that's why you have to. All right. And to understand this discussion, okay, from my experience, so the only way is practice. Okay? You have to practice a lot in order to understand what's happening here, because otherwise theory is just like that. I have nothing more to say. You have two entries, one debit, one credit. You have all the relevant categories. Just put the entries in the relevant boxes. That's it. So how can you do that? So practice is the best way. So let's take a look at this one, and we can then we can finish today's lecture. So here, so the question, the question is all about the American balance of payments. It's not Australia, am I right? This is the American balance of payments from the US perspective. So that is important, correct? So what's happening? An American buys a share of German stock. Okay, so a citizen living in the US is buying shares in a foreign company, and he makes a payment by writing a check on an account with the Swiss bank, so a foreign bank as well. So nothing to do with the US banking system, right? Pure foreign transactions. So the guy is having some deposits in Switzerland, and now he's using those deposits to buy some shares in Germany. That's it. Okay? So what can we do? So buying shares is what? It's importing, right? It's importing credit. And where do we put that information? Where do we enter that credit entry in the balance of payments? So buying shares, it is part of the financial account, right? And how many shares? But here, suppose only $1,000. It's not going to give him 10% voting right, correct? It's not likely. So you can say that this is a small amount of shares. That debit will appear in the financial and capital account for sure. And the relevant subcategory in this case is portfolio investment, okay? Because $1,000 is not likely 10% of a company, all right? Of course, you can say that in the exam. It is a kind of question. You can say, okay, I think $1,000 is going to give the guy 10% of a foreign company. That's fine. Then you can make it direct investment. We are open with that option as well. Okay, full score, no problem. Okay, the main thing is that you know what to do. Okay, that is what we want to see. How about the second entry? This is a debit. We need a credit as well. So how does that happen? The credit is coming from the payment, okay? And in this case, it is an export, right? Because the guy was using his foreign assets to make the payment, right? He was using some of his foreign assets, so he was cutting down the holding of foreign assets a bit, correct? So he was exporting foreign assets, basically, if you want. Does that make sense? He had some assets in Switzerland, and now he is exporting some of those assets to Germany, right? In order to make the payment. So clearly, it is a reduction in foreign assets. Does that make sense? And it is going to give a credit entry. Okay? All right, and this is a short note explaining what happens for the reference. So in the exam, we might ask this kind of question, but normally we make it consistent with the past. We make it Australian context. Okay, Australian context. You have to produce entries in the balance of payments for Australia. Okay, we will have Australian citizens. We will have international transactions, most likely, and you have to produce this kind of entries. You don't need to explain. Okay, so that is the thing, because we know that the exam is short, only 2 hours. You cannot explain everything. Okay, as long as you can have the answer like this, that's perfect. You have full score. Okay, and I get back to that when we get closer to the exam. But any questions for today's discussion before we go? Okay, good. So again, by around today next week, hopefully, if not, then Wednesday next week, you will receive the login your trading account with the link to the trading platform, so that you can start trading currencies. And we'll have a lecture on currency trading next time as well. Okay? So thanks for coming. I see you again next week.